Hey everybody, this is Bennett Tchaikovsky. Welcome, and let's go through and take a look at some more intermediate accounting income taxes. And we're going to talk today about some additional problems as well as rate changes. So my disclaimer and copyright notice is that the information and opinions in this presentation are those of myself and not my employers or affiliated organizations, including but not limited to Irvine Valley College and the South Orange County Community College District. The presentation is for educational purposes only and does not constitute any legal or accounting advice whatsoever. This presentation is copyright 2008 to 2026 by Bennett Tchaikovsky. All rights are reserved. Any distribution is strictly prohibited. Throughout the presentation, I'll make reference to publicly available information that is copyright of other parties, and I do not claim any right into those copyrights. Okay, so let's jump right on in with kind of a review problem. And once we have kind of gone through and looked at that review question, then we'll go ahead and start with talk about tax rate changes. So coming over here with this example. So here we've got Limelight reported the following for 2029 before the effect of any tax related differences. Just give me one moment. So Limelight reporting the following for 2029. So the first thing we want to do is we have to identify each difference as either permanent or temporary. Okay, so municipal interest income or muni bond interest income, this will be a permanent difference. Penalty expense, this is also going to be a permanent difference. And then my tax depreciation, these two collectively will be a temporary difference. So use a tax rate of 25%. So the first thing we want to do is to compute taxable income. So we've got pre-tax of 115,000. What we're then going to go through and do is to adjust this. The municipal interest income will not be taxable. So we're going to go ahead and take this 12,000 out. The penalty expense will not be deductible. Okay, so this penalty expense is not going to be deductible, so we're going to add this back. So my total taxable or my total pre-tax income is going to be right over here at 110,000. Now, with regards to my taxable income, and remember, we're going to deal with the permanent differences first. Now we're going to deal with the temporary differences. So if my tax depreciation is 40,000 and my book depreciation, I get to this number was 30,000, then I'm allowed an extra 10,000 of expense or additional tax depreciation. Okay, so my net or my taxable income is going to be $100,000. Okay. So when we go ahead and look at this, we're going to have income taxes payable, and we're going to have income tax expense. The income tax expense in this case here, this is going to be based on 110,000 times 25%. The income taxes payable is going to be based on 100,000 times 25%. And what is the difference? Well, the difference is going to be is this additional tax depreciation or my deferred tax liability. And if you ever forget about, whether something is an asset, if I need to balance with a credit or a debit, whether it's going to be an asset or a liability, I've got assets equals liabilities plus owner's equity, expenses, revenues, debit, credit. Liabilities typically have credit balances, and equity does too, increase with credits, decrease with debits. Assets typically have debit balances, increase with debits, decrease with credits. So my deferred tax liability is going to be the 10,000 at 25%. And we somehow magically get to this number. Now, as far as my disclosures go, I would want to say over here 12/31/29 to record income tax expense. Now, as far as my disclosures go, I'm really kind of saying income taxes current income taxes deferred. And then we're going to have, or basically we could call it current income taxes deferred income taxes. And then over here, we're going to basically have current deferred. Then at the same time, then this is going to give us our total provision or income tax expense. So this is going to be 2,500, and this gets me to 27,500. So as we look at this here, we've computed income tax expense, income tax payable, taxable income, and then we've also done with the deferred tax liability. Now, one of the things we've kind of haven't really dealt with until now is what happens if a tax rate changes. And let's kind of go ahead and look at some of these. And so, do tax rates change? Yeah, stuff happens all the time, right? And in fact, here for our friends at Meta Platforms, you saw that, wow, well, for income taxes, for Meta, they basically had to go through, and I'll put this up here, but you can kind of see it's like, well, the one big beautiful bill had all these impacts, right? So you're gonna see tax rates will change all the time, or not all the time, but they change frequently enough to keep Professor Brinberg, happy. But in any event, our tax people are happy because that's what they do, is they deal with the taxes. So when we're looking at the liability method, requires that the deferred tax account asset or liability be adjusted when the tax rates change, right? So for example, this question we just did right here, well, this liability, meaning we're going to have to pay it in a future year, this is now at a rate of 25%. But what happens if that rate changes? Well, if that rate changes, we're going to have to essentially go through and make the appropriate computation. So essentially what we're going to go through and do is that once the adjustment, we're not going to go through back and restate anything, where effectively this is really an estimate. We're making the best estimate that we possibly can at the end of the particular time period. And so we're going to handle those kinds of things prospectively. And so changes in the valuation allowances, that can also happen as well, as like what happens if there's a change in the tax law, or something that is no longer a temporary difference becomes a permanent difference. Well, we're going to go through and disclose it, and we're going to go ahead and make the appropriate adjustments. So again, when we're looking at this, we're going to handle these changes prospectively, but obviously the best way to kind of handle this is to look at an example. So let's go ahead and look at our example here today, talking about tax rate changes. So MVC Company began operations in prior years, and the following information is available. So they had a previous recorded temporary difference of $15,000 pre-tax. The enacted tax rate in that year was basically 20%. And I should clarify this particular question. This was basically temporary difference pre-tax relating to excess tax depreciation expense over book depreciation, e.g. a deferred tax liability. The enacted rate in that year was 20%. Then we've got over here the year ended 12/31/29. Pre-tax financial statement income, taxable income is 120. And then there's a $30,000 difference here, which is caused by depreciation. This is separate from the 12/31/28 temporary difference. And then we're also being told that the 12/31/28 difference has not reversed. The newly enacted tax rate is now at 25%. So what we have to kind of go through and do is to kind of say to ourselves, like, well, how do we handle, what's the best way to go through and to handle this? Well, we know that in our deferred tax liability account, okay, because if the tax was greater than book, right, so my deferred tax liability, and this is going to be as of 12/31/28, This is going to be 15,000 at 20%. Okay, and this really related to deferred tax liability from 2028. We'll call this 15,000. Okay. Now, when we look at my deferred tax liability from 2029, this amount here is going to be at 30,000. Okay. So when we look at these deferred tax liabilities, in total, these are going to equal up to 45,000. So we know that effectively our deferred tax liability at the very end of the period is now essentially going to have to go through and be at 25% of the amount of 45,000. So my ending balance in this deferred tax liability is going to be, again, be 11,250. And again, where are we getting this from? Well, if we look at the current year amount, right, and this, we kind of look at this here, if we have income tax expense, and this is prior to doing any type of adjustment, we have income tax expense. This is going to be 150,000 times 0.25. And let's just pretend for a moment that we just have this. Then I have income taxes payable. This is going to be 120,000 times 0.25 because that is the new tax rate. And then we would have over here a deferred tax liability over here for the difference, or of 7,500, right? Because this, if we ignore this and we just look at this, this is going to be 7,500 bucks. But we have a problem, right? We have this other thing that's kind of lingering out here. So what I need to go through and do is to figure out this adjustment right over here. I need to figure out first, well, based on what I have in there already, what should my deferred tax liability be? Well, my deferred tax liability should be 11,250. Why is that? I had a $15,000 temporary difference from the previous period that is not yet reversed. I've got 30 grand this year from the book depreciation. So my total amount of my temporary differences where my tax exceeded book was 45,000. So right now, the amount that I should have as my ending balance should be 11,250. I have a beginning balance here of 3,000. So my difference is going to be at 8,250. And I want to put this on the other side. So 3,000 plus 8,250 is 11,250. Now, if we go ahead and kind of look at this, so now my adjustment is going to be here, is going to be for 8,250. So my total income tax expense for 12/31/29 is going to be right here. But if we look at this, say, a little bit deeper, right? So this is going to be to record income tax expense. And I want to kind of take us back to what we were just looking at. If I only had 2029, right? So if I was only dealing with 2029, what would this kind of look like? Well, you'd have income tax expense. This would be 150,000 times 25%. You would have income taxes payable at 120,000 times 25%. And then we would have a deferred tax liability of the 30,000 times 25%. So this is what it would look like if we had nothing prior going on. But let's kind of really kind of think about this, right? So with this 15,000, right, this had a prior rate here of 20%, right? So this had a 20% prior amount, which was in here. Now, effectively, right, this amount now, this is now we have to kind of say, well, it's no longer 20%, it's an additional 5%. So what I effectively have to do is add in another 750. And if you look at this difference here between The what I'm recording now and the 7,500 is really this extra 750 that relates to the prior deferred tax liability. So I have to increase it because my tax rate has gone up. I'm going to go ahead and put this into my current income tax expense. So that's how we would go through and approach this problem for rate changes. I want to thank you for joining me here today. Please feel free to leave a comment. You can send it to any email, but you can also send it to ivc30thecpa@gmail.com. And I look forward to seeing you on the next video. Have a great day.